What's up, investors? It's the Russian dude. Today, we're talking about something that affects millions of people. How banks keep homeowners shackled to higher mortgage rates. If you have ever wondered why your interest rate feels unreasonably high, or why you are paying so much in monthly interest, stick around. In the next few minutes, we'll break down how this happens and what you can do to protect yourself. So yeah, first, let's talk about how mortgage rates are determined. You might think it is as simple as the Federal Reserve setting a baseline rate, that banks adding a small margin, and that's it. But in reality, banks have an entire pricing strategy that considers not only the general direction of interest rates, but also your credit score, your down payment, the type of loan you're getting, and even where you live. This becomes a perfect excuse for banks to nudge your rate upward a fraction of a percentage here, half percentage here, until you're paying thousands more over the life of the loan. Next, there's a problem of uneducated borrowers. Many people diving into the mortgage process don't fully understand how mortgage interests work, or how a small increase in the rate can mean paying tens of thousands of extra dollars over 30 years. And banks obviously count on this lack of awareness. They roll in extra fees or push you into certain mortgage products like adjustable rate loans that could spike later. By the time you notice your monthly payments ballooning, you are often locked into the deal and can only escape by refinancing, which can be expensive in itself. The culture of refinancing is another key part of the cycle. When interest rates drop, it should be an ideal time for a homeowner to refinance and reduce their payments. But banks don't always promote their best refinancing packages to current customers. They might advertise tempting rates online or in mass mailers, yet often less favorable terms to existing borrowers, hoping you will not shop around. Even if you do qualify for a better rate, fees for appraisals, closing costs, and administrative paperwork can eat up a chunk of your savings, making the whole process less attractive and keeping you committed to that original higher rate longer. Another way banks keep homeowners on the hook is by making the mortgage payoff timeline seem manageable. The typical 30-year mortgage is so commonplace that borrowers rarely stop to think about how they end up paying double the home's value in total interest. A house that costs, for example, $200,000 might result in total payments of $300,000 or $400,000 by the end of the term, depending on your interest rate. That's a humongous difference, but because it is all spread out, it does not feel like you are being overcharged in the day-to-day activities. Then there is the issue of prepayment penalties. Some loans include penalties if you pay off your mortgage too early, whether that's by selling your house or refinancing. So, if you try to escape an unfavorable loan a few years after you sign, you could face thousands in additional charges. Banks frame these penalties as a way to protect themselves against lost interest, but effectively, it punishes borrowers who try to be proactive and save money in the long run. And so finally, let's talk about what homeowners can do to break free from this cycle. Educating yourself about mortgage terms and shopping around for rates is the most important part. Compare multiple lenders, not just the one the real estate agent suggests. Understand how points, fees, and the APR, annual percentage rate, works. The more you know, the less likely you'll be taken in by the hidden costs or inflated rates. If you do sign, consider making extra principal payments whenever you can. Just be sure that your loan does not include steep repayment penalties. Those extra payments can chip away at the interest you owe and shorten your payoff timeline significantly, saving you thousands of dollars. To sum it all up, banks profit enormously from homeowners paying higher interest than necessary, and they have countless strategies to keep you in this position. But by learning the ins and outs of how mortgages really work and by carefully researching and comparing offers, you can avoid overpaying. It takes a bit more effort on your end, but that effort can translate into huge savings and an earlier escape from the mortgage debt. Well, there you have it, guys. If you enjoyed today's episode, please subscribe to my channel for more videos like this. Thanks so much for watching. See you on Wednesday.